Don't fight the authority while it is still proving its strength. Look at Bitcoin. Since August 17th, Bitcoin has moved from around $62,760 to above $73,600. That's a move of more than $10,800, approximately 17.35% higher. And look at the character of this movement. It's not just moving higher, it's moving with strength. It's moving impulsively. The bulls keep pushing price higher, and this is exactly where traders can make a very important mistake. They see the price has already moved a lot, and they start thinking, this is too high. It has gone too far. It must come down. And then they do one of two things. They close a winning buy too early, or they open a sell against the movement. But both decisions can come from exactly the same mistake. They assume that because price has moved a lot, the current authority must already be weak. But those are two completely different things. Price moving far doesn't automatically mean buyer authority is weakening. And that's the principle I want to talk about. Don't fight the authority while it is still proving its strength. Look at what Bitcoin has actually shown us. From around 62,716, Bitcoin pushed above $73,600. Higher prices, strong expansion, continued bullish development. So instead of asking, has Bitcoin gone too high? I ask a different question. Has the buyer actually become weaker than it was before? That's a much better question, because the market doesn't know that $73,600 is supposed to be expensive. The market doesn't care that you think Bitcoin has already gone too far. The market only gives us information through its development. If the bulls continue to push, if the bullish structure continues to develop, if the opposing side has not demonstrated enough strength to take control, then why would I fight the bulls? I wouldn't. And this doesn't mean I believe Bitcoin must continue going up forever. That's not the point. The point is that I don't need to predict where the top will be. I need to respond when the market gives me evidence that the current authority is changing. That's a completely different way of thinking, because there are two very different things a trader can do when a strong movement continues. The first is to say, I think this is the top, and take a position against it. The second is to say, the movement is strong, but I will watch for evidence that the strength is changing. The second approach doesn't require prediction. It requires observation. And this matters even if you're already in a winning position. Suppose you're holding a buy. Price keeps moving higher. Your position is profitable. And then you look at the chart and think, I've made enough. I don't want to give back my profit. Maybe this is the top. So you close. Again, closing a position isn't automatically wrong. If your process tells you the movement has completed, if your structural conditions tell you to exit, then closing is part of disciplined trading. But if the only reason you're closing is price has gone too high, then you need to ask yourself, did the market actually tell me to exit, or did my emotions tell me to exit? Because those are not the same thing. Taking profit because your process says the position is complete is a decision. Taking profit because you're afraid that your profit might disappear is an emotional reaction. And the same problem appears when traders open a counter position. They see Bitcoin above $73,600 and think there is no way this can continue, so they sell. But where is the structural evidence? Where is the evidence that buyer has actually lost its strength? Where is the evidence that seller has begun earning the next authority? If that evidence isn't there, then you're not really responding to the market. You're predicting it. And prediction is where traders often get trapped, because a strong market can remain strong much longer than you expect. It can go higher than you think is reasonable. It can continue expanding after you've already decided it should reverse. And if you keep fighting that movement, the market doesn't have to prove you right. You have to prove your decision was justified. That's why I don't think the question should be, is Bitcoin high? The better question is, who is still proving strength? If buyer is still proving strength, respect buyer. If seller is still proving strength, respect seller. This is also why I don't blindly support buyer or seller. I'm not emotionally attached to either side. My job as a trader isn't to fall in love with an asset. My job is to follow the authority that the market is actually giving me. If buyer has authority, I follow buyer. If seller earns the next authority, I adapt. I don't need to know which side will win before the market tells me. And this becomes even more important when authority begins to conflict, because sometimes the opposing side appears before the existing authority has actually been invalidated. That's where traders often react too quickly. A bearish candle appears, and they immediately close their buy, or they immediately open a sell. But one opposing candle doesn't necessarily mean the entire bullish development has failed. I want to see how that opposing development behaves. Does it actually develop? Does it gain structural significance? Does it invalidate the relevant bullish structure? Does seller continue to prove its strength? Or does the bearish attempt fail? That is the difference between reacting to a candle and reading a development. For me, authority isn't about one candle. It's about the development of control through hierarchy and structure. A change at one level doesn't automatically mean the entire market has changed. That's why I need to understand who has authority, at what hierarchy, how is that authority developing, and what would actually invalidate it. Then I can make a decision. This also changes how I manage winning positions. I don't want to be the trader who exits every strong movement simply because the position is profitable, but I also don't want to become emotionally attached to a buy just because it is profitable. I want the structure to determine what happens next. If the authority remains valid, the position remains part of the plan. If the movement reaches meaningful completion, I can take action. If the opposing side begins earning the next authority, I adapt. Not because I predicted the reversal, because the market provided new information. That's the core principle. Don't fight the authority while it is still proving its strength. And notice what this principle does not say. It doesn't say, always stay long when Bitcoin goes up. It doesn't say, never sell Bitcoin. It doesn't say, bullish trends always continue. And it definitely doesn't say, buy and hold forever. It says something much simpler. Don't fight strength without evidence that the strength is changing. That's a completely different philosophy, because eventually, buyer will weaken. Every movement eventually changes. But I don't need to guess exactly when. I can wait for the market to demonstrate it. The same applies to seller. When seller is strongly controlling the market, I don't buy simply because price has fallen a lot. I wait for evidence that seller is no longer as strong as it used to be. Then, I look for the opposing side to begin earning the next authority. So the process becomes, observe, identify authority, follow its development, monitor its strength, recognize structural change, manage the position, adapt when the opposing side earns the next authority. That is very different from trying to predict every reversal. And that's why this Bitcoin move is such a good example. You can look at the chart and say, Bitcoin is already up 17%. Or you can look at the same chart and ask, what has the market actually shown me? Those two questions can lead to completely different decisions. One is based on the distance price has traveled. The other is based on the behavior of the market. And for me, the second question is much more important, because price being high doesn't mean buyer is weak. Price being low doesn't mean seller is weak. A winning position doesn't automatically need to be closed just because the profit looks large. And a strong movement doesn't automatically need to be shorted just because you think the move has gone too far. Let the market prove the change. Until then, respect the authority. If the bulls keep proving their strength, why would you fight them? And when they finally stop proving that strength, that's when you pay attention. When the opposing side begins earning the next authority, that's when you adapt. Not early, not because you're afraid, not because you want to catch the exact top, and not because you think you know better than the market. You simply follow the evidence. Because as a trader, I don't need to predict the next winner. I need to recognize who is earning the next authority. Don't fight the authority while it is still proving its strength. If you want to learn more about how I approach market structure, trading psychology, and disciplined decision-making, subscribe to Bias Positive Digital Rise. Positive mindset, precise trading, more consistent profit.